So now let's look at an example that illustrates the differences among the three methods on the parent's book. If you go on Island, you are going to see this handout posted on your Island site. Please first look at the blank handout first and try to work on it on your own. So the problem is, on January 1st, 2014, parent company obtained all of the outstanding stock of Sun Company for $800,000 in cash. The net book value of Sun Company is $600,000. So the consideration transferred $800,000. And the book value is $600,000. So how much is the difference? The difference is $200,000, right? So this $200,000 is the excess payment. And then we need to allocate it among all of the identifiable asset and liability, which has a difference between fair and book value. And if it cannot be allocated, the remaining amount is the goodwill. So let's see here. The following item has fair value that differ from its value on Sun's book. So here it tells you which items has a difference between fair and book value. We have trademark, book value 200,000, fair value 20,000. So the difference is 20,000. Sorry, fair value is 220,000. So the difference is 20,000. Patented technology, book value 320, fair value 450. So the difference is 130,000. Equipment, book value is 180, fair value 150. So the difference is negative 30,000. So how much is the total difference? Yeah, so the total difference here is 20 plus 130 minus 30. So that is 120,000. So out of this 200,000, the overpayment, so the parent overpaid above its book value, 120,000 can be identified as the difference between fair and book value. And then for the other 80,000, so 200,000 minus 100,000, that's 80,000 that we cannot identify. That is called goodwill. And for this 120,000, the amount we can identify, we need to amortize it. So how do we amortize it? Because those differences can be identified to each specific identifiable asset, and we know what is the useful life for each asset. So we just divide the difference over its useful life. So for example, for the trademark, because the useful life, it has indefinite useful life. So amortization amount. So for trademark, we cannot amortize it. We don't know how long to amortize it. So the amortization is 0. Patented technology, the difference is 130,000 divided over 10 years. So each year the amortization is 13,000. Equipment, the difference is negative 30,000 divided over 5 years. So each year the amortization is negative 6,000. So what is the total amortization per year? It is 13,000 minus 6,000. So the total amortization per year is 7,000 per year. And here we also know over the next 4 years, the Sun Company report the following income and dividend. So those are the subsidiaries' income and dividend that it report. And then the requirement is to fill in the blank on the next 2 pages. So what are the blanks? Blanks are just those highlighted cells. So please take 10 minutes, try to fill in those highlighted cells. And then we're going to go over the solution. Please pause your video for now. So first, let's look at the year 2014. This is in the year of acquisition. And let's look at how the parent company, the parent, would record those recording those accounts under different methods. First, if the parent used the equity method, and then the parent will record equity in subsidiary earnings, which will be the subsidiaries. So in other words, some company's income in the current year minus the current year amortization. So this will give you 93,000. And then under the equity method, the firm is not going to record any dividend income. So net income is going to be, if you add them all up, that will give you 693,000. If the firm is using the initial value method, if the parent is using the initial value method, the parent is not going to record any equity in subsidiary earnings, but instead it is going to record the subsidiary's dividend income as its income. So some company paid out 40,000 dividend in the current year. So we record 40,000 here. And if you sum them up, that will give you 640,000. If the parent has been using the partial equity method, under this method, the only difference between partial equity and equity is partial equity does not record amortization, and it doesn't worry about the intra-entity transaction. So we only record the subsidiary's income here, which is 100,000. And then under the partial equity method, we don't record dividend as income. So if you sum them up, you are going to get 700,000. And then for the statement of retained earning, we just carry over those numbers to the statement of retained earning. And then if you add them up in your statement of retained earning, you are going to get the ending balance for your retained earning. And your ending balance of retained earning is carried over to your income statement. On your income statement, the major account we need to figure out is the investment account. So under the equity method, the firm's investment balance should be the initial investment 800,000 plus all of the subsequent income. So right now we're in the year 2014, we only need to worry about 1 year's income, which is 100,000. Minus the first year's, minus all of the subsequent dividend. And because right now we're only the first year, so we only take out the first year dividend. And then minus all of the subsequent amortization. Also because it's the first year for us, so we just take out 1 year amortization. And this will give you 853,000. So that is the balance for your investment account at the end of the first year. If the firm has been using the initial value method, so under the initial value method, the only thing that end up in the investment account is going to be your initial investment. None of the subsequent dividend, income, or amortization would impact your investment account. And then the last one is partial equity method. Under the partial equity method, so the only difference here between partial equity and equity is, again, that we don't need to take out amortization. So it is only 800,000, the initial investment, plus the first year income minus the first year dividend. So that's 860,000. And then the rest is you just do the sum, right? You sum up all of the assets, and that will give you your total assets. And then you sum up all of your liability and shareholders' equity, and that will give you your total liability and shareholders' equity. And then one last check is your total assets should be equal to your total liability and shareholders' equity. If they don't equal, there's something wrong. You need to go back and check your calculation. So this is a comparison of the three methods for the first year in the year of acquisition. And then let's look at subsequent years. So this is just jump up to 3 years later in the end of 2017. Let's first look at the income part. Under the equity method, if the firm is using the equity method, the firm is going to record the subsidiary's current year income as its income, and then to take out amortization. So it's very similar as before. So for the year 2017, subsidiary's income is 106K, and the amortization is still 7,000. So 106K minus 7,000, and this will give you equity in subsidiary earnings. That would be 153,000, and there's no dividend income. If the firm has been using the initial value method, it is not going to record equity in subsidiary income. Instead, it is going to record sub's current year dividend, which is 70,000, as its dividend income. If the firm has been using the partial equity method, it doesn't need to worry about amortization. It only needs to record subsidiary's income as its income. So, and then we just sum them up. That will give you your net income for the year. And then for the statement of retained earning. So first of all, we carry over the net income from your income statement. And here, so how to figure out the beginning retained earning? So we do know what are the subsidiaries, all of its income and dividend, but we don't really know what is the parents every year in between, what is the parents' net income and earning. So how can we figure out the beginning retained earning? So here is actually a way to figure it out. So even though we don't know the parents every year's income and dividend, but we do know that under the initial value method, the parent's beginning retained earning is 1,845,000. So we can use this number to back out what should be the retained earning under the other two methods. And please take 1 minute, think about how can we back it out. So if you think of what is the difference between initial value and partial equity and also equity method, under the initial value method, what goes into the firm's net income? It is the dividend, right? It is only the dividend that goes into the firm's net income. And retained earning is a cumulative amount. It is the resulting of all of the previous year's net income and dividend. So in order to back it out, under the initial value method, so what goes into retained earning, it is actually all of the previous year's dividend. So all previous dividend. And under the partial equity method, what goes into the firm's net retained earning? It is actually all of the previous year's subsidiaries' earnings. And versus the equity method, what goes into the retained earning? It is not only all of the previous year's earnings, but also all of the previous amortization, right? So now we know the retained earning at the beginning of the year under the initial value method. First of all, how can we back it to what the retained earning should be under the partial equity method? So we first take out all of the previous year's dividend, right? We back out this amount. And then we add all of the previous year's earnings. So this is how we can, from one method, we can transfer it to the other method. So we start from 1,845,000. And then we take out all of the previous year's dividend. So the previous years, in 2014, we have 40,000 dividend, 2015, 50,000 dividend, 2016, 20,000 dividend. Do we need to worry about this amount? No, we don't need to worry about the last 70,000 because this is for the beginning of the year retained earning. So we start from 1,845,000, take out 40,000, take out 50,000, and take out 20,000. We first take out all of the previous year's dividend. And then what we need to do is to add all of the previous year's income. So we need to add this 100,000, 140,000, and 90,000. So add 100,000, add 140,000, and then add 90,000. And this will give you 2,065,000. And this is the retained earning at the beginning of the year for the partial equity method. So how about the equity method? The difference between, what is the difference between partial equity and equity? Under the equity method, the only additional thing we need to take out, sorry, here is to take out all of the previous amortization. So the only additional thing we need to take out based on the partial equity method is we need to take out all of the previous year's amortization. So we can just start from this 2,065,000 and take out 3 years amortization for the year 2014, 2015, and 2016. We don't need to worry about 2017 because it hasn't, this is the beginning of the year return earning. 2017 hasn't happened yet. So this will give you your beginning return earning for the year 2017, which is 2,044,000. And then for the statement of return earnings, return earning ending number, we just need to sum them all up. So sum up the beginning of the year plus current year net income minus the current year dividend. That will be your end of the year return earning. And then we carry over your return earning, your end of the year return earning number to your balance sheet. On your balance sheet, the major account we need to figure out is the investment account. If it is the firm is using the equity method, the firm's investment account should be made up of the initial investment and all of the subsequent income from the subsidiary. So which is 100,000, 2014 net income, 140,000, 2015, 90,000, 2016, and 160,000, which is 2017. So one thing to pay attention here is for your investment account, we need to add all of the net income up until the current year. So in other words, here, so please pay attention, don't leave this out, don't leave the 2017 net income out because this is the end of the year investment account balance. So we need to include the 2017's net income in the investment account balance. And then we need to take out all of the subsequent dividend. So 40,000 minus 50,000, take out 20,000 and 70,000, which are just this column here, all of the subsequent dividend. And then we need to take out 4 years amortization, which are for the year 2014, 15, 16, and 17. So those are 4 years. And this is going to give you 1,082,000 versus under the initial value method, the investment account balance will only be equal to the initial investment, which is 800,000. And if the firm has been using the partial equity, we can just use 1,082,000, and then we add back the amortization. So amortization shouldn't be taken out. And this will give you 1,110,000. So, and then the last thing is, if you add up all of the assets, you are going to get your total asset. And then if you add up all of your liability and shareholders' equity, you are going to get your total liability and shareholders' equity. And then the last thing to check is your total assets should be equal to your total liability and shareholders' equity. So as you can see that the three methods, it will make a difference on the parent's book, but we're going to talk about it in the next class. After consolidation, the consolidated total numbers should be the same among the three methods. So by here, let's just look at the impact on the parent book. So the parent book will be different under each of under the three methods. So this is just an example of a comparison among the three methods. And this is all for today's class.